On the 1st of January 2026, the IRS quietly changed the rules for millions of 401k savers. Pause. Most people still haven't noticed. If you have a 401k, you might be paying thousands more in taxes this year without realizing it. At the same time, a new CBO projection says Social Security could face a 23% benefit reduction starting in 2032 if Congress takes no action. And while Americans believe they need $1.46 million to retire comfortably, the median 401k balance is just $38,176, three numbers, one retirement system, and all three are moving in the wrong direction. Pauses. Let me show you why. When you saw the title, you probably expected something dramatic, a seizure, a government confiscation. Pause. That is not what is happening. What is happening is quieter, and in some ways, more expensive. The government doesn't need to take your 401k. They already hold a future tax claim on part of it. They have since day one. Think of your traditional 401k as a tax IOU. The money is in your name, but part of it already belongs to the IRS. You just don't know the final bill yet. Pause. Starting this year, they began changing when that bill comes due, and who pays it first. We are going to walk through three mechanisms. One just started in January. One is 6 years away, and one has been running silently inside your account since the day you opened it. Then I'll give you three specific things to do this week. Not theory, phone numbers, and documents. Pause. The Secure 2.0 Act passed in late 2022, 858 pages. Most people heard about the required minimum distribution age going up, but buried deep inside was a provision originally meant for the 1st of January 2024. Payroll systems weren't ready. The IRS delayed it. It went live on the 1st of January 2026. Pause. Here is the rule. If you are 50 or older, and your FICA wages were $150,000 or more last year, your catch-up contributions must now go into a Roth 401k, after-tax dollars. In 2026, the standard 401k deferral limit is $24,500. The catch-up for those 50 and older is $8,000. If you are in the 24% federal bracket, that $8,000 pre-tax deduction used to save you $1,920 in federal taxes this year. That deduction is now gone. You are paying taxes on that $8,000 today. At your current rate, not in retirement today. Pause's Roth money grows tax-free. Yes, but the pre-tax strategy worked because you expected to be in a lower bracket later. If you earn $200,000 now and plan to live on $70,000 in retirement, the math favored pre-tax. That choice just disappeared for high earners. And if your employer's plan doesn't offer a Roth option, in many plans, catch-up contributions may not be permitted until a Roth feature is added. The rule is permanent. It looks at your prior year W-2 from the employer sponsoring the plan, earned $150,000 or more in 2025. This applies to you in 2026. Many small and mid-sized plans still hadn't added Roth by the 1st of January. They have until the 31st of December 2026 to amend their plans. That means some people discovered this year that their catch-up limit is effectively zero. Pause. Why did Congress do this? Not to punish you, to pull forward revenue. When you contribute pre-tax, the government waits 20 or 30 years to collect. With Roth, they collect this year. This fiscal year, Congress needed the revenue. Now, the timing of these tax changes coincides with growing fiscal pressure on federal retirement programs. Pause. Let me show you what that pressure looks like. Raymond retired in 2022 at 65. He did everything right. $450,000 in his 401k, house paid off. Planned to spend $60,000 a year. Social Security gave him about $2,000 a month. Solid plan standard assumptions. But Raymond didn't model 2032. Pauses. The CBO's February 2026 budget and economic outlook projects. The Social Security OASI Trust Fund is exhausted in fiscal year 2032. 1 year earlier than the 2025 trustees report predicted. If Congress takes no action by then, the system can only pay 77% of scheduled benefits. The average Social Security retirement benefit as of April 2026 is $2,081 per month. A 23% reduction cuts that by $479, nearly $5,748 per year. Over a 20-year retirement, That is $114,960 in income Raymond assumed was guaranteed. That is nearly a quarter of his original 400 wonk balance gone. Pause not from market risk, from legislative math. Pause. Three forces move that date forward. The Social Security Fairness Act added over $17 billion in retroactive payments. Recent legislation reduced payroll tax revenue flowing into the system. And roughly 10,000 baby boomers turn 65 every single day. The program is now estimated to be $25 trillion short over the next 75 years, per CBO and SSA projections. Congress has not yet passed a long-term Social Security solution. Meanwhile, retirement account rules continue to evolve. Whether intentional or not, the timing is hard to ignore. When one retirement program faces pressure, the other gets restructured. Pause. Your 400 wonk isn't just an investment account, it is a tax IOU, and the terms of that IOU are being rewritten while most people aren't reading the document. Now the third mechanism, the one hiding in plain sight. Pause. In the 1990s, a mutual fund manager ran a large cap growth fund, expense ratio, 1.2%. Not unusual. Clients got quarterly statements showing gains. They never asked what the fee cost them over time. Here is the math. Assuming a constant 7% gross annual return. Worker A invests $100,000, pays 0.5% in fees. After 30 years, $574,000. Worker B invests the same $100,000, pays 1.5% in fees. After 30 years, $432,000. That is a $142,000 different fee. Pause. The ICE and Vanguard research consistently shows that over a lifetime, high fees can consume nearly 1/3 of investment returns for median income families. You never see it on your statement. There is no line that says fee withdrawn. The fee just reduces your reported return. You see 6.3% growth. You don't see that the underlying index returns 7.5%. The difference is invisible, and it compounds against you every single year. The government collects at withdrawal. The fund company collects annually. Your 401 has two silent partners. Only one of them waits. Pauses. By law, your employer must provide a 40405 notice. It lists every fee in detail. Most people have never read it. Most don't know it exists. Meet Dave, 52 years old. $180,000 in FICA wages. Maxed his 400 wonk since age 48. Current balance $380,000, almost entirely pre-tax. Dave hasn't checked his plan documents in 3 years. He trusts the system. His plan added a Roth feature in January 2026 to comply with Secure 2.0. His payroll system automatically moved his $8,000 catch-up to the Roth side. Dave didn't know. His taxable income is $8,000 higher this year. That is roughly $1,920 in additional federal tax he wasn't budgeting for. Pauses, but here's the deeper problem. Dave's $380,000 is all pre-tax. Every dollar he withdraws in retirement is taxed as ordinary income, not capital gains ordinary income. If he retires at 65 and pulls $60,000 a year, plus Social Security, his combined income sits around $85,000. That puts him in the 22% bracket. No, apply the 2032 scenario. If Congress takes no action, his Social Security drops by 23%. He needs to pull an extra $5,000 a year from his 400 wonk just to maintain lifestyle. That extra income pushes him deeper into the 22% bracket. It may also push him above the IRMA threshold, adding hundreds per month to his Medicare premiums. Dave built a retirement plan. What he actually built was a pre-tax liability wrapped in an optimistic story. Pauses. The 4% rule comes from a 1994 study by William Bengen. It says you can safely withdraw 4% annually for 30 years. It was built on historical returns in a different interest rate environment. It does not account for tax drag on every traditional 401k withdrawal. It does not account for sequence of returns risk in year one of retirement. It does not account for a 23% Social Security reduction if Congress takes no action. To generate $50,000 a year under the 4% rule, you need $1.25 million. For $40,000, you need $1 million. Those numbers do not include your tax bill. They do not include the CBO's published depletion scenario. They do not include the healthcare bridge between employer coverage and Medicare. If your retirement plan is built on a 1994 rule that ignores your actual tax rate and the CBO's 2032 projection, your plan is using the wrong inputs, and wrong inputs produce confident wrong answers. Paz's mark is 45, earns $95,000 a year, contributes 6% to his 401k for 12 years. Employer matches 3%, current balance $162,000. His plan's average expense ratio is 1.1%. Over the next 20 years at 7% gross return, Mark reaches about $610,000. If he shifted to low-cost index funds at 0.2% available within his current plan, his balance at 65 is approximately $755,000. That is $145,000 in additional dollars. Zero extra contribution, zero extra work, one action: reading the fee disclosure and choosing a different fund. Paz's Mark's estimated Social Security at 65 is roughly $2,000 per month in current dollars. Under the 2032 depletion scenario, if Congress takes no action, that becomes $1,540 per month. Over 20 years, that lost 23% equals $110,760 in income he assumed was locked in. Mark is ahead of the national median, and his unmodeled gaps still total well over $250,000. Pauses. Here are 3 things to do this week. First, if you are 50 or older and your FICA wages were above $150,000 in 2025, call your HR department or plan administrator this week. Not next month, this week. Verify how your catch-up contributions are classified. Your payroll system may have silently moved them to Roth in January. That changes your taxable income for 2026. You need to know before you file. Pause. Second, request your plan's 40405 fee disclosure. Find the total expense ratio for the funds you actually hold right now. If you are in actively managed funds at 1% or higher, and your plan offers index funds at 0.1% or 0.2%, the difference is not trivial. It is 6 figures over 20 years. This is a number comparison. Most people never do it. That is exactly why it is expensive. Pauses. Third, run your retirement income projection twice. First, with your current Social Security estimate at full benefits. Then, with that same number reduced by 23% using the CBO's published depletion scenario. For a typical retiree receiving $2,000 per month, that is a drop of $400 to $500 per month. If the second version shows a shortfall, meaning your plan depends on Social Security working at full capacity, your plan has fragile assumptions. Building a buffer now through Roth contributions, taxable accounts, or withdrawal sequencing is not pessimism. It is accuracy. It is treating a CBO forecast with the same seriousness you treat a weather forecast before you fly. Pauses. Dave is going to be fine, not because the system is fine, because Dave is going to make those 3 calls. The people who lose are the ones who hear this and file it under "I'll deal with it later." Pause. The math doesn't care about your intentions. It only cares about the numbers. The 401k is still a good deal. The employer match, the compounding runway, and the tax deferral are real advantages. The problem has never been the account. The problem is the gap between the number on your statement and the number you'll actually be able to spend. A gap created by fees, tax liabilities, and policy decisions. Most people never pay attention to. Pause. The people who understand the actual terms of the deal are the ones who end up with the money. Pause.